All right, Super P, let's unmute up and let's get it, Super.
Let's get it. Let's get it
Another
done.
bet out of that show. I got
Yes,
my
sir.
man Patrick Doherty here. We affectionately call him Super P, and I'm
Yes.
Troy Johnson. And for those that are in the chat, just hit us up. If you have any questions or comments, feel free to hit us in the chat. We will hit you back, and we will answer your questions live if we can here on YouTube. So, Patrick, let's get right into it. I was
Yes.
referring to it just before we started the show, and that was the PE ratio and how important the PE ratio is, especially in this environment. And we all made a lot of money in 2020. 2021 is a lot more challenging in this environment. So
Right.
one really has to pay attention to the PE ratio, the multiple it is called. And so will you describe to our audience what the PE ratio is and why it is important? And then we're going to go through some actual examples so that people will better understand stocks and stock prices. I think this is like the bottom line fundamentals of understanding stocks. So Patrick, share what is a PE ratio and why it is important.
Okay, so the PE ratio is the price of the stock currently divided by next year's earnings. As simple as that. It's usually between 5 to, I don't know, sky's the limit. But the PE ratio is important because the higher that PE number is, the more investors think that stock is going to grow higher and higher. So any high growth stock, such as maybe some of those high growing tech stocks, will have a higher PE ratio than, let's say, something that's more mature and generally will be in a cash flow generation type of industry, like utilities would have like a lower PE ratio. Or some of the bank stocks might have a lower PE ratio.
Yes, and so when we're talking in terms of a PE ratio, that PE ratio is also called a multiple. And what we shared in past episodes or past that out of that show is the price of any stock is essentially equal to the price of its earnings per share. So whatever that company earns per share, that is the price that the stock should be in under par situation, under just like if we were just universally pricing a company to what it earns, the price of the stock equals to earnings per share. But in reality, in the market, people pay for growth. That's what they pay for. And so that growth is represented in terms of EPS, is how much more is the stock market willing to pay for a particular company more than its earnings per share. And that is what we call the multiple or the PE ratio. So I really wanted to show some examples of the PE ratio, Patrick.
Yes.
Just actual examples here of the PE ratio. But before I get into that, I'm going to get my screen up. Won't you describe what the PEG ratio is in relations to the PE ratio so that people can understand that relationship? Because there's the PE ratio and then there's the PEG ratio. So will you explain that as well?
Okay. So just to recap, the PE ratio is, of course, the price multiple. So price of the existing price, the current price of the stock versus next year's earnings. The PEG ratio, on the other hand, is the PE ratio divided by the expected growth rate of a stock. So essentially, you're comparing the PE ratio to its projected growth.
Go
So
ahead.
essentially, a high growing growth stock on the average shouldn't be any more than about 6 or so. And as a result, if the PE ratio or the PEG ratio is too high, that means you're paying too much for growth. That means the expectations are way too high. They're out of whack as compared to the projected growth rate of the stock. And that if you're in a high PEG ratio, that means you're probably paying way too much for a stock, and it would be advised to have the market correct if the fundamentals of the stock are still intact, and then maybe buy in at a lower PEG ratio.
Exactly. So let me share my screen because that's a lot. And I think seeing helps a lot, Patrick. So I'm going to share my screen here. And Patrick, hopefully you guys can see my screen. Can you see my screen?
I can't see it yet.
Okay, let me try again.
Okay, here we go. I can see it.
You can see it. So
yes.
So I'm on barchart.com. I've already searched for Nvidia while Patrick was talking. And so I wanted to literally show the audience what we're talking about with this whole PE ratio and PEG ratio stuff. I'm going to blow this up a bit.
Mm-hmm.
And so where I came to on barchart.com is called Price Overview. And when you look at shows of ours, past shows, you see that we use bar chart quite a bit. So when you hit the price overview option, it gives you kind of the analysis of the company and its price action. And right here, price to earnings, right here. Here is the PE ratio. Okay, so this is the PE ratio for the TTM, the 12-month. What is that?
That's the trailing 12 months. So the last the last 12 months.
Right, the trailing 12 months. So this gives you the PE ratio right here.
Right.
Okay.
Yes.
Here is the earnings per share for Nvidia. Right here, $8.14 earnings per share. So we have the PE ratio right here. We have the earnings per share right there. So looking at the PE ratio, one would say, is this price right here expensive for Nvidia? So like we said before, Nvidia price, literal price, is equal to the earnings per share, this right here. This is what the stock price actually should cost. It should cost $8 for per share. That the price of Nvidia literally should be 8, but you multiply that times the PE ratio and jack it up to 599. So if you were to multiply this by this, you should get approximately that number for those who want to do a quick calculation with the calculator. So that's how the price of stocks are determined. But how do you know that this is a good price? The PEG ratio gives you that. So general speaking, you should not pay much more than the growth rate of the company. So if you're paying more than twice the growth rate of the company, then you are paying too much for the stock. The stock is a little inflated, and that's where you have to be a little careful. So what I just said, what does that mean? That means I should go down here and look at what is the projected growth rate for Nvidia. So look at the growth rate for Nvidia. Over the past year over year compared to its past quarter, it grew 77%. Hey, guess what? Look at this PE ratio. So essentially, if your company is growing 77% and your PE ratio is 77%, you actually are okay, because people are willing to pay the growth rate times its earnings to come up with a equitable share price. So I just wanted to show that. So let's look at something in particular. Let's just look at some more interesting facts here. So I just clicked on to show more information so that I can look at the growth rate of Nvidia out in the future further. So over the next quarter, Nvidia is projected to grow 50%. What does that say? A PE ratio of 50 may be appropriate. And then over the course of 2022, just the course of next year, Nvidia is projected to do 27%. It is actually going down in growth rate. And then by 2023, it's down to 15%. Now, remember what I said earlier and why the PE ratio is important. The PE ratio lets you know how expensive a stock is, how much you're willing to pay above the EPS. And what's a fair price is the EPS near the growth rate. So if the growth rate of Nvidia is 15%, but the EPS, the PE ratio is at 7:1, that's way above the growth rate, right? So essentially, you would like to see the PE ratio and the growth rate on par, near the same figures. If the PE ratio is much more than the growth rate, then you need to look at additional analysis to determine why is this stock price so much. And if you more than 2 times the growth rate, you really need to understand what's the catalyst that's elevating that stock price. And so I essentially wanted to kind of show that. You can also see more details in Yahoo Finance. A lot of people use Yahoo Finance. So I clicked here on Yahoo Finance. And then I went over to the analysis just to do an analysis of the company. And then you go down, just skip through all of this, and let's just go to the growth rate, because essentially we're comparing the future growth rate of the company in comparison to its PE ratio to know if we are multiplying way too much on top of the EPS and this price is too expensive for the future. So let's look at the projected growth rate of Nvidia for 5 years. So you can see the current quarter. And so you see a slight difference between bar chart, right? And you will see these differences. Next quarter, Yahoo Finance is saying there will be a 50% growth, a 51% growth. Let's look at what bar chart said for that. I think bar chart said something slightly different. Where was that growth rate here? Here we go.
77.
Yeah. See more info here. Just want to show you how these different platforms have different. So no, it's the same. So yes. Over the next quarter, expect a 51% growth. Yahoo is saying over the next quarter, Yahoo is saying
51% as
51%. Well. Current year, they have 35%. And then next year, 13%. Over a 5-year period, 22% growth. So what does that say? That says Nvidia better keep improving its earnings. So what that says here to me, and let's go back to the price action, price overview. Let's go back in here and let's just go back to earnings per share. They need to increase this earnings per share. So this needs to keep going up because they will only be growing at 22%. So if they're growing at 22% and they will justify a higher price, stock price, then 2 times 22% would be a 40 PE. And so when you multiply that 40 PE times an improved price earnings per share, that's how you're going to get your new price. And it better be more than this. And so Nvidia really must have a lot of growth coming in the future for earnings per share, even though their growth rate is going to be at 22%. That's just kind of how you estimate making money in the stock market. So I really wanted to go through that, Patrick, a bit, because the PEG ratio, what Patrick was talking about earlier, is essentially the PEG ratio. If your price earnings, your PE ratio multiple is equal to your growth rate, that is a PEG ratio of 1. So when you have a 1 PEG ratio, that means you are on par with the growth rate. If your PEG ratio is minus, that means that your stock price, is priced cheaper than the growth rate. Your PE ratio, let's say if your growth rate is 20, your PE ratio is 18. Your PEG ratio would be less than 1. I shouldn't have said minus, but less than 1. That means you have a cheap stock on your hand, especially if it's a growth stock. So then, if your PE ratio is 25 and your growth rate is 20, then you're paying slightly above PEG ratio, slightly above 1, because you divide that PE ratio by the growth rate. And so that gives you an indication if a stock is expensive or not. And then you just look at the 5-year growth rate to see if all of that is in line. So I hope that made sense. I hope that detail kind of made sense. And a lot of companies, that's how we kind of evaluate stocks and know. And if you know a stock is going to grow and its price per share is going to grow, then you can easily do the calculations and predict that this $600 stock would be $900 in the future. And when this stock falls, because I don't know, Biden said something silly or something happened and this stock falls to, $450 a share or $500 a share, you would know to load up, because the fundamentals says, along with the growth rate, that this stock should really be an $800 stock a year from now, 2 years from now, 3 years from now. So that was a lot of talking on my part, Patrick. Did that make sense? What do you think?
I think that's generally true what you said, that you don't want to pay too much for growth. Like I said, for tech stocks, I like to see a PEG ratio, around 4 times the growth. Like the PE ratio, 3 to 4 times more, the amount of growth. So in this case, if we're talking about a 55% growth rate and the PE ratio is only about 71, to me, that stock might be maybe a little cheap. Just my opinion. And if going forward, the average 5 years is about 22%, if my memory serves me correctly, we're talking about just slightly more than 3 times the growth in terms of the PE ratio. So as I was saying in the intro, I like to see tech stocks no more than about 5-6%, or 5-6 times the growth rate. Here, I think the growth rate is around 3.5% for the next 5 years forward. So I think right now it's still fairly attractive, especially as they've just announced a 4-to-1 stock split.
Yeah, I want to shout out Lady T. Lady T is in the house. Hey, Patrick, that is a very good point because, and thank you for being polite in the way you said that, because I was using Nvidia as an example.
Mhm.
But Nvidia is not a Home Depot. Nvidia is not a Colgate or a, consumer staple. Nvidia is a tech stock. So the PEG ratio for a tech stock would be different than a PEG ratio for, a Kimberly Clark, if you will, right?
Yes, yes.
And so,
Oh,
so there are some sectors, and this is sector speak. So there are some sectors where a PE ratio, a PEG ratio of 1 is really appropriate. And then there are other sectors like tech, where the norm for a PEG ratio might be 3 times this growth rate. So, you look at the growth rate, multiply it by 3, and make sure the PE ratio is in line with that. And that might be cheap for that sector.
mhm.
So great point in bringing that up. And yeah, really, really good point. So what else would you like to share there before we move on, Patrick?
And um, ultimately, I think Nvidia is a great company. You may see that the growth rate might be slowing. However, that means it might be generating more cash reserve because, you know, a company ultimately is going to slow down the bigger it gets.
Yep.
Because right
So
now, the Nvidia, I think, has a market cap of about 330 billion to 400 billion. Apple has a stock, a market cap of about $2 trillion. I mean, it's not going to, double like it did in the past. It will take a lot longer for that 2 trillion to become 4 trillion. So
right.
as it becomes slower and becomes more mature, it becomes much more established, and it will generate more of a cash flow, and then it will ultimately provide a larger dividend. And that's where Nvidia will likely be going, even as you see the growth rate slow a little bit.
So speaking of Nvidia, let's talk about the Nvidia news because we're both invested in Nvidia. It is a stock that we talked about quite a bit in past shows.
Yes.
And so, what's the big news on Nvidia and why people may consider getting into Nvidia right now?
Well, the news is it was released on Friday that the company is going to announce a 4-to-1 stock split. So right now, the stock is trading at about $600 a share. A 41 stock split means that you will have 4 times as many shares, but then the price of the stock will be cut down to 25%, roughly $150 a share. Now, why is that important? Because that allows more people to get in, different types of mutual funds to get in. It may have less of an impact on the Dow Jones Industrial Average, which is a price weighted average as opposed to a market weighted average as the S&P. So it will have less of an effect. And because of it's got such explosive growth, and it's one of the biggest semiconductor or tech stocks, period, it will likely one day go into the Dow Jones, the widely followed Dow Jones Industrial Average, and join companies like Microsoft, Salesforce, and Intel.
Yeah, we're really big on Nvidia, and that 4-for-1 price split. That's a gift because we saw what happened with Tesla on their price split. I think the Apple price split did not turn out as well, Patrick.
Uh, it's been not. It's been pretty good, maybe because I think what's happened with Apple is that it is slowing. Again, it's a $2 trillion company. Can't keep growing at the rate that it has in the past. But in previous stock splits, it's definitely benefited the company.
Oh, I'm sorry about that, Miss Jams. Okay. Miss Jam's in the chat hitting me. Sorry about that. Yeah, okay. All right.
So in that regard, I mean, it's not as explosive growth, but I think in the long run, I think the stock split will be beneficial because more people can buy the stock, especially if they're trying to buy board lots, lots of 100 shares. And it's just better. And it makes for better liquidity for option traders too.
Yeah, and I like Roblox. I mean, anyone who has kids should look at Roblox because Roblox, man, your kids are in your pockets if with that whole Roblox thing. So that's a great stock that just came out, and there's a lot of institutional backing behind it. So it's another one to look at. So Patrick, let's just get into market fears.
Okay.
Let's talk about market fears. Share your thoughts on the market fears, the bond market, and all of that's happening because people are really nervous about the stock market right now. I know I'm nervous. That's why we're talking about this PE ratio stuff, the multiples, because in the past you can have really high multiples and really make money. But now the stock market is pulling back on stocks based on its multiple. And so that PEG ratio is super important. So let's talk about the market fears, and is the market going to crash? What are your thoughts?
I think, at least for now, the market rally remains intact. And especially for, everybody's afraid that tech has grown too far too fast. And I would like to beg to differ. And let me show you why. So as I share my screen, right here, this is a trend line that's been established since September.
Now, are we looking at the QQQ or what are we looking at?
Yes, I'm sorry. We're looking at the NASDAQ 100 represented by the QQQ, and that's a heavily tech-oriented index. And these are very aggressive growth tech stocks, even though there are mega cap, as you'll hear in the marketplace, mega cap tech stocks, they're still much faster growth than the average stock in the S&P 500 or the Dow Jones Industrial Average. This bottom trend line has been intact since September, all the way through now. The inflation fears started to crop up maybe a couple of weeks ago, earlier this month. So this is about May, right in here. So here, this is where the market made its peak in early April. And then when inflation fears started to come up, I think based on an unusual number in the consumer price index and the producer price index, they show elevated prices and for a basket of goods. And I'm sure if you've gone to the supermarket or gone to a gas station or try to book a hotel, prices have definitely moved up. However, that might be temporary because in the end, because the market has come down quite a bit and money-making assets have come down, growth assets have come down, that tends to be self-correcting over a longer period of time. And as the fear has gotten worse and worse and worse, it's hit the bottom trend line right here. So this trend line has definitely held up. And as you see, the market has gone back up to the 50-day moving average, which is a key moving average. And as one could see, the trend line of the 50-day moving average is still slightly upwards sloping, even though maybe less upward sloping in the last few days or few weeks. And I'm looking at the bond market right here, like the interest rates. Right here, interest rates peaked.
Can you blow that up a little bit, Patrick?
Can I blow that up a little bit? Yes. Let me see what I can do here. Is that a little bit better?
Yep.
Okay. So as I highlight, this is where interest rates have peaked, and this was well before the inflation fears. Um, the market had just gotten a little bit ahead of itself, I guess, on the bond market, and then people were fearful of growth, and then the bond market interest rates have peaked at around maybe 1.72%, whereas in 2020, when you saw a lot of the stay-at-home technology stocks do really well, the the interest rates are around maybe 6.67%, so less than 1%. And I think it's the rapid rise in interest rate that initially spooked the market, but then the market came back, the tech market came back. As I explained in another show, okay, give me 1 second here. Right about here, the market came back, and right here, the market made an all-time high. However, to reflect excessive growth, you would think that interest rates, especially if the inflation fears are high, should be way up here. But in fact, they're lower than the peak here. So I think, to me, based on the lower interest rates of this peak here, this is where the inflation fears start to begin, versus the excessive growth rate here, and the fact that the market has pretty much not violated this trend line that's been in effect since September. That tells me that the market still has a lot more room to grow.
So it sounds like you're bullish.
Yeah, I am bullish
on the tech sector, on the QQQ.
Yes.
With tech guys, I mostly invest in tech as well. I got a question in the chat.
Yes.
And it is from Tony Johnson.
Mm-hmm.
Question is, do you think the market is artificially inflated due to COVID stimulus?
That's a very good question. I think it could be, well, there's no question that the easy monetary policy has kept stocks high. The COVID stimulus has allowed for asset prices, and essentially people who have businesses not to, and the Fed's definitely been accommodative, so that could be particularly artificially high should that stimulus run out, and on one day it will. However, I think because of that stimulus, that's going to create a multiplier effect throughout the rest of the country and the economy, that ultimately the Fed could pull back and the Treasury could pull back on the accommodative monetary policy, the accommodative fiscal policy, and the growth will just kind of feed on itself. And I think because interest rates are still relatively low, that the market can continue to move higher as the economy will continue to expand.
Gotcha.
So in a short, I don't think the market, yes, initially the economy was held artificially high because of all this stimulus, but right now I think the economy is starting to be self-supporting more than it was in 2020.
Okay. Interesting. Okay. All right. Anything else to share there, Patrick?
No, I think that's about it. I think, just do your research on the companies that you wish to invest. I think the upward trend is still there. I think to be, one should be well diversified and not just be in tech, but in general growth stocks as a whole. Another good ETF based on the S&P 500 is VOO. I think that has the best management fees, and you want to be in the S&P. And as I said in a previous video, most, if not all, fund managers over a 5-year period of time will not beat the S&P 500.
Hey, Patrick, I have another question in the chat, and that's from Miss Jams.
Yeah.
And she's asking, on a smaller scale, can you do analysis on AMC? Is that a good buy? I have my personal views on AMC.
AMC, so that's the movie theater company.
Yeah. Would you pull the chart on AMC? Would you pull?
Yeah, I could definitely do that.
I like to look at the 6-month on AMC, and I don't know, Miss Jams, if you want my opinion. I have been in the market for a good 30 years as well, but AMC, I think you can look at the way I'm shaking my head.
Let me see if I could let me get it's a little bit.
So Patrick, I'll let you do your AMC thing, and I will give my
So
view.
This is AMC. I think it's badly manipulated by, you have a war between the shorters and this Wall Street bets crowd. Like the Wall Street bets crowd wants to prove that they could do better than the hedge fund shorts, and so the hedge fund shorts obviously think they can outdo anybody else. I think there's just too much volatility in AMC. I think I would stay away from it. It's just too much volatility. There's just too much crap between these Wall Street bet crowd and these shorters. It's just way too volatile.
Yeah, Miss Jam, hit me in the chat and tell me what's your interest in AMC. Let me share my opinion on AMC. And I'm on the same page with you, Patrick. But I do have a degree of prejudice because, like Mark Cuban, I am a real big Netflix holder. And so I am of belief that we will have more streaming content in the future. So if you're trying to do a short-term trade, COVID, market opening up, I think AMC is going to have a short-term pop, and you can make a trade, make some money on the trade. So it's good for a trade. But if you are looking for a long-term investment, then and really try to buy on the dips, and that's kind of what we do. We look at growth stocks, and then when it falls in price, we'll look at the PE ratio, compare it by its growth rate to see if it's a 1-peg ratio, a 3-peg ratio, or whatever is good for that industry to know we're buying at a great price, and then make money on the upside. So if you're looking from that perspective, then that's AMC would not be a pick of mine. I think streaming is the future.
I think
I see HBO doing it. I see all of the channels doing it. Even this COVID environment, people do not want to be packed among each other, even though they had the COVID shots. I'm not a big fan of AMC, Miss Jams, but I'm glad you're here contributing to the show. So I asked more questions, and hopefully I wasn't offensive. But go ahead, Patrick.
Yeah. Just to add on, I would look at Disney as well. Disney has a streaming entertainment division where they stream content. As well, they have the theme parks. Everybody wants to go to the theme parks now. I think that's going to be a great play. Ultimately, in the long run, I think that's going to be better than AMC. And of course, Netflix. I would agree with you on Netflix as well.
Yeah. Netflix has a lot of competition, but they're just spending way too much money, and they're just they're the top dog. What do you call it? The blue chipper So, I mean,
The best of breed.
Best of breed is what I was looking for. But yeah, Miss Jams clarified in the chat. She says she's just doing a short-term trade. Yeah.
Okay.
Yeah, short-term trade, yes. When COVID's over with, everyone's going to be rushing to do stuff. But hopefully you have a great exit. And like James LeGrand, he was on the show last week and he talked about this, and it's super important. And that is, you go into a trade with an exit strategy. And if your thesis fall apart, you have to get out of the trade. You cannot become a cheerleader and just cheer. You'll lose even more money. So have a good thesis, go into the trade. If what you were expecting in that thesis do not realize, get out of the trade, cut your losses, please. It's just not worth being a cheerleader and losing 3 and 4 times as much. So that would be my advice.
Mine too. Mine
okay.
too.
Well, I mean, that's it, Patrick. We had Tim Brown supposed to have been on the show today to talk crypto. An emergency popped up in the 11th hour. And so Tim is not here today. Tim was going to talk about the crypto crash. And he was going to share all of his knowledge in crypto on the crash, but he'll be here next week. He was sharing some text behind the scenes of what's going on. It's a real legitimate 11th hour emergency. So not going to have him on the show today, but certainly what we wanted to do today was share, our thoughts on the market, our thoughts on PE ratio. We've been emphasizing it over the last few shows that really you have to look at that PE ratio and understand the growth rate of the companies that you are interested in to know if you're getting a good price and you can hang in there, because the companies that have very high PE ratios in comparison to its growth rate, they're going to get really hit very hard in this market. I'm pretty convinced of that. And like I said last week, I have taken money off the table in some of those high PE ratio stocks because the market is not paying those type of prices for high PE ratio. Your PE ratio has to be somewhat in line with the growth rate comparable to that sector. So Patrick, before we wrap up, what do you want to share there before we go?
Yeah, I just want to talk about one of my favorite stocks here.
All right, let's look at it.
Called Applied.
Jams. Anyone else wants us to do a live analysis? We know a lot of stocks, so just hit us. We'll be happy to do that. But go ahead, Patrick.
So I want to talk about Applied Materials and how its support looks really good. Again, so let me blow this up a little bit. So we're talking about a trend line that's been around since, mid-November, December of last year. And it's one of the top stocks in the SMH ETF, which is one of the best performing ETFs for technology. And as you can see, the stock has pretty much held up against this trend line. So what was once resistance here, so it tried to break it up here, break through it here, but then it came back, and then eventually it broke through in early 2021, around January or so. And then ultimately, even after the inflation fears that tanked a lot of tech stocks, this stock has pretty much held up. And it looks like it's in a consolidating pattern and might be ready to break out again based on those technicals. And you should see the 50-day moving average is still trending upwards. And that's also very important.
Very, very good, Patrick. How does it look on this 200-day moving average? The 50-day moving average, for those who are not familiar with technical analysis, I did a show on this as well back in the past. You can go look at it. But the 200-day moving average shows the long-term growth trajectory. And so if the squigglies, the lines, the price action of the stock is above the 200-day moving average, it shows over a long term the stock has a growth trajectory, it's going up. And so it's a good bet to buy it when the stock falls. And so, and the 50-day average shows short-term growth. So if it's above in the last 50-day over the 50-day moving average line, then you have even short-term growth. And so if the stock falls below the 50-day, but above the 200-day, that might be a good opportunity to buy. If it's too far above the 50-day, price could be, getting out of hand a bit, and you might want to wait for a pullback to the 50-day before you buy. So those are some of the technical analysis, just to break it down quickly, of what Patrick is talking about here.
So here's the 200-day moving average. So since November, between May and October, it's been relatively flat because the stock was relatively flat in 2020. But then, as the growth continued to accelerate in the economy and throughout the general market, this 200-day moving average has started to trend higher at a faster degree angle. So here it's relatively flat. Now it's a little bit bent up, or quite a bit more bent towards 100. So to me, that tells you that the growth rate is accelerating in this stock, based on this 200-day moving average here.
Yeah, good point. Yeah, you do look at the ends of those technical indicators. If they're bent up, that shows that it's still growing up. So, that's another good indicator for buying stocks, individual stocks. I mean, you can look at things like the 200 moving day average to show that long-term, over like years, this stock continually go up even when it dips. So that alleviates a lot of the fears when the market goes crazy and stuff. It actually makes you want to buy because the stock is actually on sale, because you saw the 200-day moving average and see that, over the last 5-10 years, it always bounces back and go up. So just good technical analysis. And that 50-day, Patrick, is great indicator when to buy. It's one of the good indicators. When that stock pulls back to the 50-day, based on its short-term trajectory, man, it's time to ching, 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 if you have a real growth stock. And again, we talked about that in past shows. You can go to the website, www.betoutofdebt.com, and all of our past broadcasts are right there, and you could just pick whichever ones you want. You can even look at our pre-production stuff, post-production stuff. Is all on betoutofdebt.com. And shout out to our web designer Shannon Allen for putting that together for us and being our web developer and consultant. So shout out to you, Shannon. So Patrick, is that it for the show today?
I think that's it for the show today. And if anybody has questions about what was just discussed.
Yeah, I don't see any questions related to anything that was just discussed, but I did see a comment about price per shares is currently at. Hey, Devo's in the house. What's up, Devo? Good to see you, man. Man, you need to hit Bowler and let me get your digits again, Devo, because I don't have your digits, so I need to be good to text with you. But Miss Jams had a comment about price per shares is currently at. She wanted to know where's the EPS at AMAT, I believe. Can we see AMAT? What is the EPS for AMAT? And then what is the PE ratio? And what's the growth rate? Is that AMAT fairly priced?
Yeah, we could take a look at that really quickly.
Yeah, let's look at that real quick.
Give me 1 second. So for the bar chart, just going to type it in right now. AMAT.
That is a good question.
Yeah, excellent question.
Yeah, you're talking all of that technical stuff. So that question that Miss Jams is asking about is really a fundamental analysis question.
Exactly.
Yeah.
And that's we appreciate that question, Ms. Jams. Okay, so let me share my screen real quick.
Yeah, let's take a quick look at that. I'm not sure that was her question, but it's become my question. So, so we'll see.
So can you see that?
Yeah, blow it up a little bit, Patrick.
I will blow that up a little bit
That's
more.
that's the trailing 12 months, the TTM, which is the trailing 12 month. So there's the forward PE as well.
Okay, give me
So we're
one
looking
second.
at the trailing 12-month PE.
Okay, so it's about 24 price per share. So right now the earnings per share is $4.59 a share, and
Hit that see more there.
see more.
Yep, hit
Yep,
it right there. Mm-hmm. Let's look at and come down. There we go. Let's look at that growth rate and the earnings. Yep, growth rate next quarter. Ooh, look at that, 66%.
36%. For the next quarter. Fiscal year is 45.80, and for the fiscal year 2022 is 9.87%. So, and the earnings surprises have always been really strong. When they report, so they report above earnings, and it's just been a really good performer and fundamental.
Can you go to Yahoo and let's look at the 5-year.
Yeah, I go to Yahoo and
5-year. Go Yahoo, pull up AMAT, please.
Yeah, 1 second.
Just do the search on AMAT there in the search bar. There. And, oh yeah, you already got it, Patrick. And will you go over to analysis?
Okay, so
go up, please. Go up where you can see the sub bar. Keep going up.
Analysis, right here we go.
Yeah, go over to analysis, click on it. And then that first column after analysis comes up, let's go all the way down to the bottom on that first, and we'll see the growth rate down there. EPS trend, keep going down. Here's the growth rates. And then let's look at the 5-year. So 5-year
is 21.43%. Yep. And although the last 5 years have been 36, so it's still got quite a ways to grow, as one could see.
I wonder what the PEG ratio, the traditional PEG ratio has been, how many times the growth rate is, PEG ratio traditionally for AMAT, but very, very good question. So, I mean,
fundamentally, it looks like a very good company. I mean, it's still growing quickly. It's not terribly expensive from what I see. If it's got a 24 PE ratio and the growth rate is around 21% over the next 5 years. Yep. And then the analyst recommendation is very high, about 1.
Yeah, we didn't even talk about looking at the analyst recommendations, because you can look at the analyst recommendations on Yahoo. And then if you were to go back to bar chart, let's do that real quick, Patrick. That's another thing by,
so anything above 2.5 or less than 2.5 on the scale is generally considered a buy to strong buy. And right now you see a lot of strong buy ratings and buy ratings, no sell ratings.
Let's look at AMC real quick and see what they say about AMC. I think Ms. Jams would appreciate that.
Okay, we could put it in comparison.
Yeah, let's look at AMC on the fly. That would be kind of cool to see. And let's look at the analyst ratings. Let's go up to analysis and look at that.
So here you look at the underperform. So some say buy, strong buy for whatever reason. However, I would not be a holder here. It currently trades at $12.08. The average projected analyst price for the stock is 4.86 for $4.86. So it's way overvalued.
Yeah.
Next 5 years, we're looking at a growth rate of
minus
17. Past years,
look
about
at the
6.
growth rate. No. Let's stop right there, Patrick. Look at the growth rate of AMC. It's
Yes.
projected to go down by 200%.
And that's probably not just AMC, but the overall industry in film.
But
and,
this
and,
is
and big
this
screen
is
theaters.
AMC in particular. But again,
Yes.
I mean, what Michelle said was a short-term trade, and that's a good short-term trade, to be honest. I like it. It's gutsy. It's a gutsy, but it's not a long-term trade. So we're long-term
Definitely, yeah, definitely not something that you would want to buy and hold, or I would say even over the last 6 months.
And then Patrick, can you go back to bar chart and just look at what we were looking at before the AMAT
Yes.
back, and let's look at the analyst rating on AMAT. So if you were go back here, and then we'll you might have to type it in to get that screen back. I like to show people how to get the analysts, because these smart people, that's what they do. They sit here and they analyze these companies. They look at the growth rate, the PE ratios and stuff.
So the analyst ratings would be
come down, keep coming down. Ooh, you just went too quickly and it's just disappearing. And maybe you can tap your cursor so it doesn't. And yeah, and come down a bit. It's below the options. So if you keep going down, if you can get down below the options on bar chart, it has the analyst rating. And what I like to do is I like to look at YouTube, not YouTube, good gracious, I'm tripping. I like to look at Yahoo,
okay,
and I like to look at bar chart. There's the analyst rating right there on an analyst. So you click on it and look what they say currently over to the right, Patrick.
Yes.
Strong buy. So the analysts say this is a strong buy. So another cheat code on how do you buy stocks and how do you make money over the long term? Because the short term, the market just does crazy things, but at a micro view, but at a macro view, there's enough analysis tools, from fundamental analysis to technical analysis, to get a pretty good percentage bet that you're going to win. So hopefully these tools are helping people.
Yes.
So, okay. If we do not have any additional comments in the chat, then maybe we can wrap up, Patrick, if you stop sharing your screen.
Yes, I shall.
Okay, so I think that's going to be it. Our crypto guy was not able to make it in. He said he would possibly call in if the emergency died down, and it did not. So that is cool. It happens.
Yes, it does. It does.
And so, essentially, let's see what we got here. This is the Bet Out of Debt show. We call it Bet Out of Debt because when you place a trade, it is really called placing a bet. And hopefully it's a winning one that will keep you out of debt. And as always, we'll see you next week, same time. And hopefully you will keep investing and have a great weekend. Goodbye.